supply and demand strategy. So I do have a few slides. I will also be going through the charts, talking through different examples when it comes to supply and demand. And also I'll be going through any questions that have been submitted. So I can give you feedback on any of the setups that you've been looking at, or sorry, any questions or challenges that you might be facing. So let me begin. I'll start by sharing my screen and we can go from there. Right. So what you can see on screen is what I'll start with by going through an introduction and talking about myself. And for those of you who don't know me, my name is Alex Morris. I am a full-time instructor here at the Academy. Sorry, just give me 2 seconds. My son's just popped in for 2 seconds. Sorry about that. I'm back. I've been here. I'm a full-time trader and instructor at the Academy. Previous to trading, I was an accountant, and I was doing that for about 10 years, working in different industries. I worked in the water industry. I worked in the tobacco industry, and also in the alcohol industry as well. So I did that for 10 years. Really enjoyed the companies I worked at, but now, I actually live in Perth. So I was born in the UK, born in London, moved to Bristol and live in Perth, Western Australia. I've got a wife and 3 young boys who are 9. You probably saw one in the background trying to dance. I did see him as well. So he gets his dance moves from me mainly. And the youngest, who's 4 years old. So 3 boys keep me busy, keep me entertained, that's for sure. And I'm a massive sports fan, so Newcastle United, that is my team. I do follow them quite a bit. We had a nice result last night, winning 4-0. So can't complain too much. But all sports, rugby, um, badminton, squash, anything. Massive sports fan. Terrible swimmer though. I'm not very good at swimming. I've always struggled with that. Um, but yeah, do love going in the pool, going to the beach. So some of my other interests include property and traveling. So I, when I was back in the UK, I lived in a house which required a bit of doing up, required a bit of TLC, and that required knocking walls down, rewiring, plumbing, a massive job, but really enjoyed it at the same time. And with traveling, really enjoyed going to certain countries, or to be honest, all countries. Love exploring, love seeing the world. And Slovenia, going to a place called Lake Bled, absolutely loved it there. Thailand was great. Um, Spent 6 weeks in Thailand, New Zealand as well. Really enjoyed those countries, and still a lot to see and do in Australia now. Now, I've got a few special talents. Some of you might be aware of these from the previous cafe session I've held, but I do claim to know all the capital cities in the world. I ran in the National Athletics Championships in 2006, 2005, 2006 for 400 meters, and I could do a very well, or the well-known dance move known as the worm, which essentially involves you doing this on the floor. That is the worm dance move, which I won't be doing today, I'm afraid. Maybe some other time. And as I mentioned, born in London, gradually moved to the West Coast, developed a Bristolian or certain Bristolian accent, talking certain words which sound very Bristolian. West Country, and now living in Australia. I don't think I've got an Australian accent yet. I have been here for, was it July last year now? So yeah, a year and 3 months. That really has flown by. So yeah, loving life out here, and that's it. That's all about me at this point. So let's talk about the strategy. Let's talk about, this is the book, or an extract from the book, and here you can see some examples of supply and demand zones. I'm just going to click on this link here, which will take us to the supply and demand book, and it's taken an extract from the book. And here it talks about supply and demand, my background, what I've achieved, why I got into trading, and then I go on to talk about the individual steps. So firstly, identifying areas supply and demand. So areas supply are essentially areas where we're looking to go short. Areas of demand are areas where we're looking to go long. Very simplistic terms. And then there are some examples. So essentially what we're looking for is consolidation or balance in price. We then want to see that move either lower or higher. So in this example, we can see prices broken downwards from that prior area of consolidation. In order to take the area of supply, we take the previous bullish candle, and then we draw what is essentially a rectangle. That is our area of supply. So if we look on the chart, we've got consolidation. We have the imbalance in price, so bearish imbalance. We want to take the previous bullish candle before that move. That's our area of supply. So there's an area of interest mainly for sellers in this scenario where we're looking to go short if we see the next steps being fulfilled. Now, the exact same happens with demand zones. We are taking the previous bearish candle before that bullish move up. So here, we'll draw in our rectangle. That's our area of demand. And then we can see here just some examples of what we would call or class as weaker bullish imbalance, because we are breaking recent highs, but we still have price action to our left. So yeah, there's the move up, and then we're looking for a reaction from those zones. And when we do get that reaction, or before we get the reaction from that zone, the actual retest is fairly key, because we may get a more impulsive move back to a level of supply or demand, so a very quick move, or we might get a more gradual retracement. It's almost viewing it as a trend line, essentially, rather than just a few candles very aggressively moving in one direction. So we want to favor the more gradual retest. But when it does come back to either an area of supply demand, whether it's gradual, whether it's impulsive, we then want to see if there is a reversal candle, some kind of confirmation to tell us whether to go long or short from that area of supply demand. So here, this would be an example of a pin bar where the body is less than 50% of the overall candle. That's an indication buyers are stepping in. Vice versa, from an area of supply, if we see a bearish pin bar where the body is less than 50% of the overall candle, we're looking to go short. Generally, the smaller the body, the better the confirmation towards either the lower or upper end. And yeah, these are other examples of bullish pin bars, bearish pin bars. Note the bearish pin bar here, how it's green in color. That is still applicable. Very much just focusing on the wick rejection. We then have engulfing candles as well. So this is an example of a bullish engulfing candle. Green body engulfing the prior bearish candle, or the green body engulfing the red body, the whole candle engulfing. Now, it doesn't matter if the wick engulfs the previous red candle. You may have scenarios where the body engulfs, but the wick on the red candle is bigger than the green. That doesn't matter. As long as the body engulfs, then you have a valid confirmation. And here you can see the bearish engulfer, the body's engulfing the prior bullish candle. Here are some rejections as well, known as tweezers, where you've got essentially two pin bars next to each other. And you also have 3 candle swings as well, which we'll look at on the live charts. And these are examples of rejections from either a supply or demand zone. Here's your confirmation, your bearish engulfer, and here's your bullish engulfer from a demand level. So once you have your confirmation, it's then time to set your stop loss and take profit. So stop loss at the top, take profit towards the demand level. And with your stop loss, I generally say 5 pips below recent price, or sorry, above recent price action if it's at an area of supply, 5 pips below an area of demand if you have a long position here. So that 5 pips is your minimum. There are also aggressive or passive stop losses that I refer to, which we'll come on to as well. But you want to target recent highs or recent lows, ideally, with a 2-to-1 in mind. So that would be risking 1% for a 2% gain. So when you've got your parameters sorted and you've entered the trade, you're entering the close of the candle, it is then very much a set and forget. There are times where you are looking to exit potentially one of these trades earlier. That is during big news events. So if you've got high impact news events and you are at break even, let's say, in most cases, you are likely, or the best approach would be to exit the trade prior to that event, just to avoid any potential volatility being stopped out quickly, preserving your capital. So that's one of the rules, and I've highlighted 3 other rules. 2-to-1, make sure that you go into a trade with at least a 2-to-1. We're not looking at 1-to-1 trades here. We're looking for higher risk to reward. Using fresh area supply demand. So if prices come into an area of demand, we see confirmation, there's our entry. If there isn't confirmation, and then price comes back up and then back into that demand zone, we're not looking to re-enter there. We're only going off touch and hopefully an immediate rejection. You might have price consolidating here for 10 candles, and then you've got your entry or confirmation. That would be deemed as less favorable. So we want to, well, we can still consider it, but look to reduce our risk. But certainly if price is broken out, come back in, we avoid taking those trades from either a supply or demand zone and not trading the news events, as I mentioned. So you can check Forex Factory. There are other websites as well, investing.com, if you want another comparison. But as long as you're aware of those high impact news events, you are in a good position to plan ahead. I then go through some examples in the book where I'm very much showing examples of strong confirmation, entries from weak or strong areas of supply and demand, depending on how or what the higher time frame is showing. So if the higher time frame is bullish and we've got strong rejections from a demand zone, then you've got favorable elements on your side. Yeah, this would be an example of a weak supply zone because you've got price action to your left, but you've got balance, imbalance. Note the bearish aggression, touch, and then a good pin bar rejection there. And you've got lows to target. You've got more range-bound price activity, price action here, which again can be difficult to trade, and it's better suited to trending markets, but you can also benefit just from these aggressive moves and seeing the rejections from those levels. Right, okay, so that is a quick view of the book. I'm now going to go through each of the individual steps and talk a bit more in depth on step by step on how to identify these opportunities. So the first step is looking at the market structure on the higher time frame. So I do look at the Forex, sorry, I do look at major and minor FX pairs. I don't look at indices, commodities. It is purely FX. So if I pull up TradingView, and we can have a look at Swiss yen. Always a good example that I like to refer to, especially if you are new to trading and you just want to get an understanding of which pairs are more favorable to look at. Swiss yen certainly is in that bracket when it comes to long opportunities, because when we look on the market structure on the higher time frame, so I'm looking at the weekly view here. So we've got 2 years of price action here. You can see generally we've been trending up, especially where price is at this point. We've had, well, this week has been certainly more bearish, but overall favoring long positions. So I focus on the weekly and also the daily, just to get that higher time frame view and establish a bias, whether I'm going to go long or short when I start looking at the hourly. So generally speaking, going to favor long positions, but because of this more recent bearish price action, long positions may be slightly more difficult. So market structure in a higher time frame, if you look at Swiss yen, predominantly bullish. That's on the weekly and daily. Market structure in the lower time frame. Now, when I start looking at the lower time frame, I had a quick glance on the hourly. I like to get a view of the last 2 weeks, generally speaking. So 2nd of October today. If we go back to, what's that going to be? Let's say roughly the 20th of September. Doesn't have to be exact, but it's more just to get a view of where price is now over the last 2. You can even look at last 3 weeks. You can even take a more extended view out just to see if there is any discounted areas of demand, which we'll touch base on. But to keep it as simple as possible, if we look at the last 2 years, so 2 weeks here, you could say, well, it's increasingly bearish. We are seeing a lot more bearish price action. So starting to favor and starting to go against what we're seeing on the higher time frame overall. We're not going with that bullish momentum making new highs. So step 3, narrow consolidation on the 1 hour time frame. Now, this is where we start looking at opportunities. So if we focus on more recent price action here, this is a good example of narrow consolidation in the sense that the body of the candles, there's very little movement, generally speaking, and then we see sellers stepping in. Another example there, 2 candles, then imbalance down. So that tells us that sellers are prepared to, or there's clear intent from sellers at that particular level. We then want to see a rejection from that level to either look at short or long positions. So in this scenario, short positions, but we're actually coming up against a demand zone. You're getting conflicting views, but step 3 is all about narrow consolidation, an area of balance. This is typically our area of fair value, buyers and sellers interacting before sellers step in and seeking new areas of fair value, essentially. That's step 3. We've got step 4, the aggressive move up or down. So this would be an example of a aggressive bearish move prior to that balance. So imbalance down. We want to see an aggressive move. That's our indication that sellers are stepping in, or potentially even buyers from levels of demand. Indicates institutional involvement and where potentially the big market players are looking to place orders. So this example here, this supply zone will be a good example to potentially look to go short from with lower risk. Excuse me. Oh. Excuse me. So that's an example of an aggressive move. You wouldn't deem or regard these as aggressive moves because it's very much range bound. Sorry. Excuse me. And you only have to zoom out just to really see the extent of that move. And it's a good example of supply. And if we look at this demand zone where we saw a near touch and buyers starting to step in, note how there's a green line just above it. But I'm just going to zoom in here. Got balance, imbalance. We're starting to break highs. Buyers stepping in. And then we see continuation up. We come back to that general level and we are seeing buyers step in again. Now that level of demand is starting to lose strength. The more time progresses and the more time that sellers keep coming back to that level. But yeah, step 4 is all about that aggressive move, and that's how we identify either a supply or demand zone. Now the retracement. So with the retracement, we can have either a gradual retracement or an impulsive retracement. So this would be more of an example of an impulsive retracement. We've got imbalance in price, imbalance back up. Whereas this could potentially be a more gradual retracement, depending on how the move happens. But you know, if we start to see this trend line, essentially, example like this, that would typically be a better example of a retracement. There's more liquidity being built up. And then if we see confirmation, sellers looking to step in, rather than impulsive move, there's a lot more volatility, there's a lot more indecision. There's more questions to be asked. So that's why we prefer a more gradual retracement. And then the confirmation candle. So we do have 3 examples of 3 different types of confirmation candle. Firstly, we have the pin bar. So this would be an example of a bearish pin bar. Note how the body's towards the bottom end, and you've got the extended wick there. Just zoom in a bit. There. An engulfing candle. So this would actually technically be bullish engulfing, bearish. The body's engulfing. Note how the wick isn't engulfing. That's still fine. But that is an engulfing candle. That's a better example. The body's fully engulfing. And then we have a 3 candle swing. So this is very slight, but this is actually a good example of a bearish 3 candle swing. And what we're looking for in a 3 candle swing is the 3rd candle. So if these are the 3 candles we're looking at, the 3rd candle to close below the open price there. And for a bullish 3 candle swing, it's the opposite. Yeah, the opposite to that. So then the 3rd candle close above the open price of the 1st candle. But we have a 2nd candle, which is very much a doji. That is a favorable or a good example of a 3 candle swing. And we want that to happen on an area of supply and demand. And then lastly, once you've got your confirmation candle, you're looking to set your entry, stop loss, and take profit. So if we just zoom back a bit and have a look, that was the near demand zone touch. Excuse me. Let's go to a more recent example. I'm just going to look at Euro Yen, for instance. So here we can see a bearish pin bar, entry at the close of that candle, stop loss above, targeting a 2 to 1. So this is where, so when it comes to stop loss, just to go through it again, we've gone to the top of the supply zone. This will be known as a passive stop loss. So 21, that's in the entry to the top. 26 will be your stop loss, and then you're targeting a 2 to 1. So ideally, we want to be targeting lows, just about there. So very close. But that'd be an example of a a short position from a pin bar rejection. Here, you have an example of a bearish engulfing candle. So this is 5 pips. So if we say 23, 5 pips, which would be 28. And then here, you would be anticipating new lows. 2 to 1, based off that engulfing candle. Close of that engulfing candle. So that is, oh, went through Swiss yen, but that Euro yen was just to show an example of different confirmation candles. Set your stop loss and take profit, and always be mindful of the high impact news events. So I typically reference interest rate decisions from the major banks, CPI, your inflation report, and also non-farm payroll. Those are the 3 biggies that you certainly want to be particularly mindful of when it comes to high impact news events, and making sure you're not in trades during those times, especially if you are at break even when you've got nothing to lose. Yes, it can go in your favor, but it can quite easily go against you. Right, okay, so then the next slide here, this is the first trading post that I posted on Monday. And yeah, thank you everyone for your comments. And it was all about, would you take this setup? Would you take this trade? So firstly, it's valid. You've got balance, narrow range, imbalance in price. You do have a more impulsive retracement. You've got 4 or 5 candles, 1, 2, 3, 4, 5 candles. And then you've got a confirmation. So it is actually technically a pin bar, but the issue is that that confirmation candle is weak. Look at the size of the move. It's not really telling me that sellers are looking to step in. It's not the strongest bearish reaction from that supply zone. Now, one reason for that, it could be due to low levels of liquidity. So this particular example is pound Swiss. The time that this bearish pin bar formed was, I think, at 2 or 3 a.m. So we're trading, or the candles formed outside of the European session. Therefore, liquidity levels are generally going to be much lower. You're going to see less volume. And I think on when it got to 7 or 8 a.m., that's when UK time, that's when you started to see market participants coming in and the move started to be bigger. So these are still trades to consider from a technical or strategy perspective, but it is just them being mindful of when you're executing and appreciating that, okay, it might not be the strongest confirmation. Let's look at other opportunities potentially, or reduce risk. And then the other post I put on was around whether you'd stay in this trade or not. So firstly, it's very favorable from a strategic perspective. You've got good balance, you've got imbalance in price, making new lows. You then got the retest, more gradual. You do have a slightly later confirmation, the 4th candle engulfing, but there is confirmation. Stop loss is then, that's 5 pips above, targeting new lows. So we would be anticipating a continuation lower. Now, you can see from that confirmation, I think this was maybe on a Tuesday, nothing happened for the whole Tuesday, Wednesday, Thursday, and then Friday. So this was taken just before the weekend, and you're essentially at break even. Nothing's happened. So what do you do? Do you hold the trade over the weekend? Do you take that risk? Or do you close the trade, preserve your capital? And this is where it does become difficult, because you've got a very good setup here. The last thing you want to see is on Monday morning, it goes straight to take profit. But ultimately, you want to be preserving your capital and not overexposing or risking too much, because there could be events over the weekend which might cause price to gap open higher considerably against you. So always have in mind preserving capital, making sure that you are feeling comfortable with whatever position size you're going into the weekend. And if you are holding trades, look to reduce your lot size as well. Okay, these are just some examples of some recent trades based on price action. You've got here one bullish candle, imbalance in price. So this is US dollar Swiss, very bearish on the higher time frame. You have a very strong rejection indicating that the next move is going to be lower. That green line actually indicates a key level as well, making it riskier, but a lot of good elements there. As I mentioned, the bearish pin bar rejection and the higher time frame being very much bearish. We're transacting at weekly and daily lows. This is another example, Euro Australian dollar, where if you look at these lows here, we're just about breaking it. I know that's green in color, but it's very much bearish imbalance. So you've got good balance, imbalance, touch, and then you've got this late pin bar rejection. Stop loss above, and then targeting new lows. Got very much a continuation here. You only got one bearish candle, imbalance in price, making new highs. We then get touch and then a pin bar rejection. So it's red in color, but the body is 50% less than the overall candle, just about making a valid opportunity. And this is an example where you've got good balance, imbalance up, balance, imbalance in price again, seeing this strong rejection. We're actually closing inside the demand zone. So this is a riskier trade because we're not closing above the demand zone. However, Euro Yen, very bullish. This red line indicates a weekly high. So expect resistance, but at the same time, very much bullish in nature. So if we have a look at some current opportunities, just focus on. So this is now Swiss yen that we had a look at. We just had a quick look at Euro yen as well. And you can see here, if I just zoom in a bit, you have one bullish candle imbalance. You're actually starting to close below those lows. So you technically have a supply zone there. So I'm just going to move that the way so it's clearer. So you're taking top, bottom wick, imbalance, and then we come back into the zone. Now, in terms of a confirmation, let's say an engulfing candle, we'd want to see the next 25 minutes price close below the open price there. The difficulty you have is, okay, if we go short, and then I'm saying 30, let's say 34 pips above the wick, 5 pips above, then targeting a 2 to 1. So we're going to be anticipating new lows. We look at the daily. This is at a level where we can see multiple recent lows where buyers have been stepping in. So we've got some room to play with in that regard. But it is just technically riskier because of where we stand on the weekly and how bullish it is overall. We're just at weekly highs. But how I view this is we're looking to go long. We're still looking to go long. Just not at this point based on recent price action. If we look at some of the other pairs, so CAD Swiss is an example where here you're not making new lows. It's very bearish on the weekly. Note how where price is at this point. We are transacting at weekly lows. This will be a weak level of supply because of where price is closed. It's not breaking those lows. So those are areas I would start to disregard. But certainly any bearish continuation from there, clear bearish moves, starting to favor short positions on CAD Swiss. US dollar CAD, looking increasingly bullish. We just want to see a break above those highs. But on the daily, not as clear cut. You've got a lot of price action. These highs here are an area to be mindful of. But certainly with regards to more recent price action, you've got levels of demand being respected. You would expect a move higher at some point, either today or tomorrow before we go into the weekend, based on price action. EuroCAD, we are at weekly highs as well, so very bullish. We are coming into a level of demand potentially, but we're also struggling in that area. So long opportunities are still a consideration if we get good confirmation. Euro British pound is an example, an unfortunate example, but an example where you've got good level of demand, there's imbalance in price there. We've come back into that level. We don't have that confirmation. There's no engulfing candle, there's no pin bar, there's no 3-candle swing. It's just price coming into that area and subsequently moved higher. The reason why that demand zone is favorable is because how bullish it has been. These are your daily, weekly highs. I'll just zoom out. You can see where sellers have been stepping in multiple times, and we're back at that level again. So when we start to approach that level, we still want to consider demand zones if the other elements are being met in the strategy, but we just want to be cautious of, price action at that level and making sure that we're not, let's say, I use 1% as the amount of risk you put on per trade. We're not going to be putting on 1% there because of price transacting at those weekly highs. So that's Euro British pound. And then another example is Euro New Zealand. Not so much the recent sentiment or price action, but certainly you can see multiple demand zones. The fact you can see that on the hourly just goes to show how bullish it is on the daily and on the weekly. And you have to look at that. I'm just looking at price action all the way back to March 2022, and you can see how bullish it has been. So we're at weekly highs. You can see I've marked out a supply zone, and that would be an example of a weak supply zone. It's bearish in balance, but there's a weak confirmation there. It's not closing inside the supply zone, but we can ultimately see buyers now stepping in. Right, so those are some of the opportunities. Now, the next slides, I'll just go through some of the questions that are being posted and give you my feedback. So firstly, Gurkamal, so can you please answer my questions? So can you explain how weekly highs and lows as well as daily highs and lows influence trading decisions? So for example, they have significant support and resistance levels or affect trade entries and exits. So hopefully just going through those recent examples will help you, Gurkamal, but you still look to enter trades if you are bullish at weekly highs. If the other steps of the strategy are met, you just want to be more cautious because you might see price fail at those levels as well. So look to reduce risk is the main point there. And then number 2, so many times my trades hit stop loss and then they go to take profit. So I usually place stop loss 5 pips above or below the rejection candle. Should I adjust the stop loss, entry timing, or trade management? So if we look at your setups here, if I look at this particular example, now you've got price not making new highs at that point. not touching the demand zone. It's a good pin bar. You've gone aggressive, so there's that. What's the word I'm looking for? There's that, let's say, indecision, or there's always the risk of price coming back into that demand, which it eventually does. But when I look at this, I think you've got this area here, balance, imbalance, breaking highs, retests, you come into this demand zone, and then you're seeing the rejection. Pin bar, your engulfing candle. So your entry should be earlier rather than going off that one. Now this one, so can't see the demand zone here. Could be quite unfortunate with your stop loss. Just be mindful of when you are marking out your demand levels, as soon as you get the touch, reduce the size of it. So cut it off there. Don't keep extending it, just to avoid any potential other setups occurring. So remember, fresh supply zones, fresh demand zones is what we're looking for. But yes, you could be unfortunate here if you have that slight spike above. This is known as a liquidity grab, potentially, where you've got a number of stop losses at below a key level before price then goes higher. In most cases, not too much you can do. You might have wicks below that level of demand where it's created. If you do, might be a good reason to give yourself more breathing room and say, okay, I can still achieve a 2-to-1 targeting those highs. Doesn't always have to be 5 pips. It can be 10 pips. Just, yeah, do bear that in mind. Very similar here. You've got later confirmation. Just, oh, sorry. There's nothing wrong with your stop loss 5 pips below. You're being stopped out and then price goes higher. Just be mindful of the points I've gone through previously. If there are wicks below that demand zone that you have created. And here, pound Australian dollar, very bearish. You can see multiple supply zones where price is making you lows. There as well, balance, imbalance. That's probably a better entry there, or another entry. Got the rejection. But from your point here, you're not making new lows, so it's slightly weaker. You've got good confirmation, stop loss 5 pips below above, targeting 2-to-1 lows, which is good. Sometimes going passive above the highs is another consideration, but then you're anticipating new lows in this example. But you haven't done too much wrong there. Very clear bearish market. It's a good setup. You're just not making new lows at that point. And Jack, so fellow Bristolian here. Oh, it's good to have another Bristol. I say a Bristolian. I'm not actually from Bristol. I lived there for a number of years, but yeah, lived in Japan, and 40 plus heat is no joke. We're not quite there yet. 17 degrees at the moment, but it is 9:45 at night, so summer is coming and it will be getting to that heat. Anyway, if you take a trade where price didn't quite touch the zone isn't mitigated technically, can you use it again in the future? Short answer is yes, you can. Just loses favorability as time progresses. I've had a look through some of your 300 backtested trades. There are some less probable trades I wouldn't have taken or even spotted. Do you take most technically valid trades and reduce risk? How do you decide when to take a trade and reduce risk versus sit on the sidelines? So staying on the sidelines mainly when most of the steps of the strategy aren't met. So gone through the 7 steps at the beginning, let's say 3 or 4 are met. That's telling me that I've got a less favorable setup, probably going to stay on the sidelines. Plus, if there's an upcoming news event, more reason to stay out. Do you trade at reduced risk if unable to target previous highs or lows, even a strong trending market? Yes, slightly reduced risk. So if you are at weekly highs, it's very bullish, but the only thing that's going against you is that you are targeting new highs. rather than risk 1%, you're risking 0.75. What if the supply demand zone is quite old and the retracement into it is therefore quite a big trend? It seems a lower probability to trade because you're anticipating the trend will reverse at the zone. So do you reduce your risk for these trades or just trust in the strength of the zone? So if it's going with the higher time frame, then you see a price break, a supply or demand zone, or a demand zone, let's say, from a bullish market, there is a clean break. Then um, um, so here you are looking to reduce risk essentially. If you're seeing, and I think I've gone through a couple of examples earlier where you've got more bearish sentiment against a higher time frame, those discounted levels of demand are becoming less and less favorable. Now, I appreciate we should focus on supply and demand, but flip zones intrigue me. I'd like to know a bit more about the rules around them. So what needs to happen for you to place a limit order? Does price need to break structure after going through a zone? So in a prior video, you mentioned a demand zone that became a flip zone, but a short opportunity was invalid because prior price action wasn't making higher highs. So yeah, when we're looking at flip zones, essentially, so let's say you've got a bullish market, you've got price making highs, you've got multiple demand zones, and then suddenly one of those demand zones, you don't have confirmation for it, but you see a really strong bearish move, indication that sellers are stepping in. This trend might be reversing. If that does happen, so we've got 1, 2 bearish candles breaking through a zone of demand, that becomes a flip zone. And essentially looking to execute a short position from the bottom of that demand now turn supply. But yeah, that is a high level summary. There are other points to consider, which I don't have time to go through today, but that is what you're looking for. Go on the trend and you're seeing that break from a former area of supply demand. Justin, do you suggest closing trades before spread out begins between the New York and Sydney Open? Find that increased spreads during this time, stop out my trades on a demo account. It's certainly a consideration. I think also knowing the fixed spreads on your broker, that will help. But if you are constantly stopped out, just review how big the moves are, because there might be other elements to consider. It might be a case of a different broker potentially. There are going to be examples where you do see extreme moves, but yeah, if you are more of a day trader, that might not be applicable. But if you are swing trading, you might have more bigger stops, and then that's where you've got a bit more room to play with. Gherkin, can you please answer one more question? If the market is ranging on the higher time frame, should we take trades? If yes, what trades are more favorable? So if it is ranging, you want the other steps of the strategy being met. So you want, let's say, bullish market, you want aggressive buying. You then want a strong confirmation from that level of demand. Those are the kind of elements that you are looking for if price action on the higher time frame is ranging. And then Jack, is the average 55% win rate taking every valid trade, or is it after filtering out lower quality setups? So this would include the more valid and favorable trades in that scenario with the 55% win rate. And how do you manage risk around correlated trades? So just make sure that you're not risking more than 1% essentially, or keeping it as close to that 1%, because if you start going above that, that's where it starts, or you start to become more and more exposed. So Rishab, if the market seems to be in a consolidation phase, also termed as an accumulation phase, would you still look for entries, or would you say the supply and demand zone are less likely to be respected in these scenarios? So in most cases, no, you wouldn't be looking for entries in that particular example. They can still be respected if you've got level supply and demand at the top and bottom of let's say, a ranging market. But yes, they will generally be less favorable. And then Star, I took these trades on Tuesday and Thursday, September. They both played out well using your supply and demand. Really nice bullish trend on US dollar CAD this week. So look at my charts. Let me know if anything you would like to add. And then you also talk about, can this strategy be used on indices, specifically US 30? So the strategy only looks at FX on the hourly. I find there's too much noise, generally speaking, in the lower time frame, 15 minutes or below. And I haven't back tested indices enough to really recommend it. So Forex, there's plenty to look at. The major and minors, that is. When we do look at your setup here, couldn't quite see, not sure where your demand levels are. I'm guessing you're going off that. So the bearish candle imbalance up. I'm not sure there's a breakaway in price. And then here you can see there's bullish momentum, bullish imbalance not breaking those highs. And then you've gone off an entry there potentially. So yeah, need the demand zones to be drawn out in this scenario, and then want to see confirmation from those levels. Pin bar, engulfing candle, free candle swing. So Esmond, I think I've already answered this question earlier, well, just a moment ago, but it is just a Forex trading. But where do you usually set your stop loss? So 5 pips below an area of demand or above an area of supply as a minimum. So you've got passive or aggressive stop loss, but as long as it's 5 pips, that gives you enough breathing room for those trades. Alexandra, first is on trading days. You mentioned being more cautious with trading on Fridays. Does that mean you're more likely to close trades on a Thursday evening when price hasn't reached your profit target? And do you monitor on Fridays? And also, how do you treat Sundays? So I still look at the markets on Fridays. Activity is generally lower when you look on the markets on a Friday, especially when you go into Friday afternoon. And I tend not to hold over the weekend unless it is a very, very good setup. So Sunday is always preparation, reviewing the prior week and then preparing for the week ahead, looking at major news events, looking at which FX pairs are the most favorable. So then you've attached 2 examples of what you believe are valid flip zones. So would you look at these trades? So this first example here, this is where you've got bearish market and then you've got a bullish move. So you want to be in this scenario, if it's a bearish market, you want a supply zone and then a bullish move breaking. You've got the opposite here. So you've got a clean bearish break, absolutely. That's good. But you've got a bullish move. So you want to see continuation and then a break from that continuation. So this would be a weak invalid flip zone. Whereas this has a bit more validity to it. So let's say you've got prior supply zone. So let's say you've got bearish market, very good supply zone there. And now we're coming back into that level. Now you want to see clean bullish break, which you've got 2 bullish candles there. But you want to see it break away, then retest that level. So your entry will be at the top of the flip zone, then that continuation. Stop loss is in a reasonable place as well. You've got cover below that wick there, which is good. But always bear in mind flip zones, going with the momentum. So you're just looking at supply zones or demand zones, and then bam, you've got that really strong move breaking a demand zone. There's no confirmation. There's no confirmation for supply zone. That's when flip zones, a flip in sentiment essentially start to come into play. So Courtney, started trading journey, go through the trading modules. So I'd like to start get my journey with strategy. So my question is, should I be including screenshots of each component in my Excel sheet? So you can take that approach, but you can just have 1 or 2 screenshots. So you could have one just having the higher time frame sentiment, and then the other one having the execution on the lower time frame, because then you've incorporated all the elements, hopefully. But more importantly, in your comments, in your notes section, talk through each step. You can even have a checklist. You can highlight each of the steps I've gone through at the beginning, and then tick each one of those off if those steps are being met. So L badge, learn the SMC before, and now I use it in TradingView as an indicator to identify bullish order blocks and bearish order blocks. And I saw your strategy. My question is that bullish order blocks or bearish order blocks in the SMC indicator, can I use them as a supply and demand level? Thanks. So I'm not actually aware of the SMC indicator, to be honest. So not something I can recommend or comment on. I don't use any indicators either. It's very much just based on price action and those moves. Kevin, what kind of screening process do you run to determine which market you want to look at? So I go through each major and minor FX pair at night, in the morning, throughout the day as well. But night and morning are the preparation and review times. And then I decide which ones are more favorable, give more attention to those, look at those supply and demand zones, wait for them to be mitigated. If there is a heavy news week, let's say in the US, then I might not even consider trading that currency. Let's say this won't happen, but let's say you've got CPI, interest rate decision, non-farm payroll all happen in the same week. That technically won't happen, but let's say if it does, the US dollar is likely to experience a lot of volatility, big moves. So generally speaking, we want to avoid those periods. And Jack, you've got some questions here. So do you solely aim for a 2-to-1 risk, or do you extend? In most cases, I stick to a 2-to-1, but you can extend targeting highs or lows. If you do decide to aim for more than 2-to-1, what do you take into consideration? Do you take partial profits? So partial profits is a good consideration, and it is just targeting as highs or lows is when you can look to extend. So daily highs, daily lows, and we looked at a couple of examples. Let's say Euro New Zealand, where you've got that discounted demand zone, where you can then have a potential 6, 7, or 8-to-1. With a 40 to 50% win rate, what sort of losing streaks do you generally expect? So you can have multiple losers in a row. You could have 10 losses in a row. That isn't unrealistic or crazy. It's why the long-term mentality is so important. And do you place much emphasis on monthly profit, or do you look at your account from an annual gain perspective? So I do look at both. I don't exit trades early because it's the end of the month to boost my results. I just look at stick to the trading process rather than monthly or yearly gains. So Bavin, this will probably answer some of the questions which you've just gone through there, but I know you aim for 2-to-1, but one of your trades last week on Euro New Zealand went much further, hitting 6-to-1. See many trades go further than 2-to-1 and feel like profits are being left the table. So target daily, weekly highs if possible. If that isn't possible, and let's say you are making weekly highs, 2-to-1 is what you do. You take 2-to-1. You then look at your other demand zones. You've got demand zone there, imbalance up. Another opportunity, add to your position. Imbalance in price there. No confirmation, but you then see rejection up. And then lastly, the question I had was from Jesse. So thanks again for the feedback. You had some questions. So you had the screenshots here. So firstly, engulfing candle entry, which is spot on, but bearish engulfing bullish candle there from a level of supply. Stop loss is incorrect. You want to go above the wicks there. So ultimately would have been a losing trade, but stop loss does need to be more passive above that 5 pips above the high. With this setup here, you've got an invalid entry. Price has already come back into that demand zone, broke away and came back in. So that's an invalid entry. Good setup in the middle here. You've got bearish imbalance. So balance, imbalance, good pin bar rejection, like that setup. This would be a weak demand zone because yes, you are failing to make new lows now. And then you've got some bullish imbalance, but not really breaking structure. Still a difficult area. Confirmations there. That's what we call a riskier trade. And this is good as well. Balance, imbalance, breaking lows, touch. You've got your 3-candle swing, a weaker 3-candle swing. But yeah, you certainly see the continuation from there. And then with these two setups here, weak level of demand, I can see price action to your left, not really giving me indication that buyers stepping in. Good confirmation, but not enough as an alone element to really give you that favorable trade. Really good balance, imbalance in price. Now we're starting to see some breaks in structure. Just got a weak confirmation there. But yeah, not bad. And that was it. So hopefully that's been helpful, guys. I appreciate all your time, and and yeah, I will see you all at some point soon. Thanks again for all your comments. Really appreciate it, and yeah, take care.